The biggest Wall Street banks slashed their small business loan portfolios by 9% between 2008 and 2009, and that's more than double the rate at which they cut their overall lending, according to the latest Congressional Oversight Panel report on TARP. Here now with more, Elizabeth Warren, chairman of the Oversight Panel. And Chairman, having talked to you so many times in the past, I know how this must gall you. How do you explain it?
You know, this is really infuriating. We put hundreds of billions of dollars into these largest Wall Street banks on the explicit representation by the then Secretary of the Treasury, Paulson, who said we put the money in and that will give us lending and that's going to get the economy going forward. And let's just be clear. Putting that money in, no strings attached, it didn't happen. We didn't get the kind of lending that we thought we were going to get coming out of this. And what's so deeply worrisome is exactly the number you pulled out of our report, and that is there was an overall cutback, but the cutback was twice as big for the smaller businesses. And think about the long-term implications of that. You know, big businesses, if they can't get money from banks, they at least have options to go directly into the market. They can issue bonds. They have other ways to access credit. For small businesses, if they can't get money from banks, they can't get money. And that means they shrink, and in some cases, they die. If we play that out over time, and there's more money available to the big businesses and less money available to the small businesses, we really end up tilting the playing field so that the big businesses have a real advantage over the small businesses, and that's not going to help us on an economic recovery.
Well, Chairman, can you factor out you'll hear that demand wasn't great in the middle of the slowdown for small businesses. I mean, they were afraid to hire people. Maybe they weren't expanding as much. You need to factor that in to some extent, right? And I guess the other thing is we've gotten, with banks, we've told them to be much more careful about lending after what happened. So can we really expect them not to adhere to what we want them to do by not tightening credit standards?
It's a fair enough point. On the demand side, there are a couple of points to make. The first one is, sure, you know, demand undoubtedly has something to do with this. I do want to make the point, it is enormously frustrating that we don't have good data. We didn't track this money when we put it in. We don't have good data about how it was used. We don't have good data about how the lending went, how many applications there were, what was turned down. So that means to some extent we're flying blind in this area. But I really want to draw a line under the big business, small business difference. At least there's no obvious theory why demand would shrink for small businesses at double the rate that it would for large businesses.
Actually, Elizabeth, there is an obvious theory.
Go ahead.
Okay. If you look at the assets that small business has, it's about 38% in real estate. And real estate obviously is the sector that took the giant hit. So if you say that real estate lending is down dramatically, and that has a disproportionate share of exposure in small business, you would expect small business loans to lag loans to large.
Except
companies.
Remember, the C&I loans are separated from the real estate loans. We've actually done our...
but the companies in the real estate business who are borrowing are going to be in the C&I loans.
Fair enough. There will be some in the C&I loans, but I don't think that explains double the difference here. And at least what we're hearing from the small businesses themselves, that they can't get the loans. But I am willing to go to the point again and again. We don't collect good data on this. And, you know, we have to remember with the small businesses, we have a kind of double problem here, and you identified it. To the extent that the large financial institutions have cut back disproportionately on small business lending, that means small business lending is falling more to the intermediate size and small businesses and small banks. They're the ones who are carrying the larger portfolios on the commercial real estate that is so likely to be in trouble. It's in trouble this year, coming up for resets in 2011, in 2012, in 2013. So we're getting a bad intersection here.
Elizabeth, what would you do about it, and would your suggestions apt to be adopted?
Well, remember, our point is to review Treasury, but let me start with where Treasury has gone with it. The good news is that Treasury thinks that simply putting more money into banks without any strings attached is probably not a successful approach. They have now gone to Congress and said they want a new loan facility, the small business lending facility. They want to commit $30 billion to that, but it's going to take an act of Congress, and that means Congress has got to vote on it. That means it's going to take some time to get it up and running. They do put some strings on the money, and the strings on the money are to put an incentive into re-lending that money, into putting it out into small businesses. The money will be cheaper if the bank can demonstrate that they put it into small business lending. But you know, if we're counting on this to do the recovery, we've got to remember, we're now, 18, 19 months into this, several more months before you can get a program like this up and running. It just simply may not be enough. The small businesses, I want to underline while we have a chance to do this, 2 out of every 3 new jobs created in America comes out of a small business. 50% of the private workforce is in a small business. If they don't have adequate access to credit, it's not only a problem for them right now on whether they can survive, we can't fund an economic recovery.
Elizabeth, I have one question. It's a very obviously a difficult question, but should we have a securitized market for small business loans?
You know, it's an interesting question, and we've really looked into why there isn't more of one. And here's the basic problem. You can lend on mortgages, you can lend on credit cards, largely on numbers, right? What credit scores look like and how long someone lived in the property and so on. Maybe we didn't do it well on mortgages. But the point is can be a fairly numbers-based lending. That's why the big financial institutions went to it. Small business lending still tends to be, it's referred to as relationship lending. That is, somebody really has to dig in and say, well, a dry cleaning shop there makes sense. Let me understand what your IT idea is here and what kind of assets you're going to have. That's much more expensive, and it also means they're much more one-off. And that makes it much harder to put them into securitized pools and have any transparency about the value of what the investor's getting.
I'm looking at, have you seen the cover of Time magazine, Elizabeth?
Hmm.
You haven't seen it yet? It's you and Shapiro and Chair Bear, Sheila Bair, the new sheriffs of Wall Street. And it's interesting. It's interesting. A nice pose. You didn't pose for that? I guess they found a picture. Here it is.
No. We had our pictures taken. I haven't seen.
You just haven't seen it yet. Oh,
I just haven't seen it.
You weren't being coy. Anyway, congratulations. Looks like a good read. And I like what Geithner said. If the question is posed, what if women ran Wall Street? And he goes, well, the bar's pretty low. They couldn't have done any worse. So anyway, congrats. Thanks for your appearance today. We appreciate it.
Thank you. Good to talk with you.